Hello, everyone.
Hello.
Oh, I still seem to be losing students. Oh God, I don't know what to do. If you know anyone in the class, please encourage them to make sure to attend the classes. It will be helpful. Maybe I should start a penalty on not attending the class. Next time I'll do that. Anyway, how's life for everyone?
So far,
Good. How
so
about
good.
you?
Life is blessed. I'm hoping the weather will change. It started to change, but then again, took a turn back. So hopefully it'll change. I don't know. Though for those who like winter, it's still winter, uh, and I hope everyone remains healthy. Just be careful. I know government has relaxed the rules, but you're your best advisor. So please be careful. Just don't get sick. That's about it. I can tell you. Your parents would not like you to get sick. Uh, I know I still tell my kids, or not kids, means they are big boys now. They laugh at me. That it's like, Dad, we know it. I said, I know. It's so difficult to understand the feelings unless and until you become a parent. It's like, so I just tell them that I know you won't understand it yet, but one day. Why do I have to talk to you every day? I said, just send me a text. That's it. Oh God. Anyway, I I know you go through the same thing with your parents, I guess. They just care about you, and please do take care of yourself. Anyway, anything anyone else wants to share? Why do you guys not keep your cameras on, man? At least enjoy the class. At least I can see someone. I see Kate. That's about it. And now Maggie has started the camera, but I cannot see Maggie because of the light way it is coming on her face. So, hi Maggie. Are you doing well? Good, good. See, everyone else is still off. Anyway, uh, questions, guys. Questions. Nope. Okay. I hate to be. I hate it to be a one-way conversation, but you seem to love this. You're taking a picture, Maggie. You're taking a picture. Your phone is off. Your mic is off. Okay, no problems. I'll get started since you are not sharing anything. Any good news? Anyone's birthday today? We can sing the happy birthday song.
My band released a song and we hit number 2 on some random radio station in Australia.
Wow, very good. Oh, also, our IUP's EMBA program was ranked second in one of the rankings. Just so you know. Uh, that was a good news. I can tell you which
Very
ranking.
cool.
What's that?
I said very cool.
Yeah, it's cool. I can tell you. I just got a message today. Uh, is anyone planning to join the EMBA or MBA program? Yes, no? Today, let me share the screen. Uh, uh, so this was ranked one of the 25 top EMBA programs in the nation by Great Business Schools. I think ours was ranked number 2. That's what I was told out of 21st 25. So at the IUP's Pittsburgh location. I'll be teaching there in summer. Yep, number 2 ranked EMBA program in Pennsylvania. Sorry, not in the country. It was in top 25 in the country, but number 2 in Pennsylvania. My bad. But again, still an achievement being in top 25. Okay. So we'll start with the quiz today, see if we can do a few problems here. And then if you don't have any questions, then I'll move on to the next topic. I'm hoping you were able to practice the problems. And again, as I said, write down the formula, fill in the numbers, and make sure you understand the interpretation. When you are actually paying more than what you budgeted for, it is unfavorable. When you are paying less than what you budgeted for the same thing, it is favorable as far as the cost side is concerned. As far as the revenue side is concerned, obviously, if you make more than what you budgeted for the same number of units, it is favorable. We are not going to use negative or positive signs. We are just going to use the interpretation. Now, you should be able to see my screen, connect screen, and problem number QS21-11 on direct labor variances. So first thing is we have to compute the direct labor rate. When we talk about the direct labor rate, basically what did we pay? Actual rate we paid was 15 and standard rate was 14. So basically we paid more, $1 more than what we budgeted for. That's why this rate variance is going to be unfavorable. So that is the first determination always. Okay, is everyone clear on that, please? And then you basically have the formula actual rate minus standard rate, which is $1 for actual hours, which is 68,000 hours. So 68,000 unfavorable. Now, as far as the efficiency variance is concerned, we have actual hours 68,000, standard hours allowed are 69,400. That is given to you. So, or you might have to compute it depending upon how many hours are needed for every unit. So standard hours allowed and are 69,400. So you are allowed this budget of these many hours. However, you only use 68,000 hours. So you used less, you are more efficient. You used less resources than what you were allowed. So difference is 1,400, and this 14, this will be a favorable variance because you used less than what you budgeted for. Standard at the standard rate of 14. So 69,400 minus 68,000, or other way around, 1,400 times 14 gives you 19,600 as a favorable variance. If you net it out, it is 48,400 unfavorable. Any questions on this, please?
No, that all makes sense.
Okay, so everyone is okay with it then?
Yep.
So again, as I said, write down the formula: actual rate minus standard rate times actual hours. Actual hours minus standard hours allowed times the standard rate. That's it. It is nothing more to that than that, and fill out the numbers. The company's flexible budget is 14,000 units. For sale of 57,400, variable cost is 15,400. And fixed costs are 20,000. The fixed cost expected if the company produces 20,000 units, assuming that this is within the relevant range, is 20,000 because the fixed cost does not change. Means there's nothing new over there. A company's flexible budget is 23,000 units with a contribution margin of this and fixed cost of 39,000. Now, what is the operating income expected if the company produces 26,000 units? So this is the budget for 23,000 units. So this is, so if you divide 124 by 23,000, you get $5.40 as the variable cost per unit, or sorry, the contribution margin per unit. So 540 times 26,000 gives you a new contribution margin minus the same fixed cost, gives you an operating income of 101,400. Okay, make sure you, if you have any questions on this flexible budget, please. Yes, please. Any questions? Okay, moving on then. This is very similar to what we did just now. You got a production and sales of 23,600. That's a budgeted. Anticipated variable costs, fixed costs, same thing, and operating income of this. So now you have to do the budget for 21,600 units. You know that the variable cost per unit will change. So your selling price per unit is at $9.10. Sales at 23,600 units. Sales is equal to variable cost plus fixed cost plus operating income. So sales, we found out It has given you that information, your variable cost, fixed cost, and the operating income. That's your sales. Selling price per unit is given to you. So budgeted sales will be 21,600 times 9.10. So it's just working that same equation. You could have basically made a contribution margin income statement and basically worked out the sale. Is everyone comfortable with it?
Yes.
Okay. Feel free to stop me, please. This is the same question, more or less. You can do it. Now I'll go over this. In this case, you have to find out the actual cost of direct materials used. Now, when we talk about direct materials used, which formula are we going to use? When we talk about the direct materials used, which formulas are we going to use? Direct material price variance or the quantity variance?
The quantity variance.
Quantity variance. So you know that the quantity variance has that particular number in it, right? Which is basically your just keep that in mind. Now, what do we have to find out? What we need to find the actual cost. So if you look at the two formulas, I think I'll just write it down. It's just easier. And this is your price variance. Your quantity variance is right. And the total is basically, if you add the variance of this, gives you the total direct material variance, right? So if you think about it, if you break this down, actual price times actual quantity minus standard price times standard quantity. So what does the first thing give you?
The actual cost?
The actual cost, right? Because this is the actual cost. And this is your standard cost allowed. So what do we have to find out? We need to find out the actual cost. Okay. Kate, are you with me?
Yep.
Okay, does everyone understand that part, please? So if you don't read this carefully, you'll end up using the wrong formula. Okay. So is that clear to everyone? Means I went through all this just to make sure that everyone reads it carefully and everyone understands it.
Yes.
Yes.
Okay. So once we have that, now let's look at the information that we have. We know that the direct materials are standard. This is the standard, £6 for $6 per finished unit. Total direct material cost variance is unfavorable at 18,750. So we know that the variance, cost variance is, or the price variance is basically unfavorable at 18,750. So if the variance is unfavorable, that means did we pay more or less than the budgeted?
You paid more.
You paid more, right? And whatever the budget is, we paid more by
18,750.
18,750. So our standard was 30,000 units that was actually finished, and $6 were what was allowed, right? So standard quantity allowed for the actual output is 30,000 units. For the actual will be 30,000 units times 6 times 1. So your cost of the budgeted direct material is 180,000. Does everyone understand that?
Yes.
So if our standard or budgeted is 880,000, our variance is unfavorable by 18,750. That means what we actually paid was 198,750. So this minus this is 18,750, and that's where we came. Sorry, I made a mistake here. It should have been actual quantity. Sorry, I just wrote it wrong. It should have been actual quantity being out. Okay. Try this on your own. Make sure you are able to come here at material price variance. Just confirm the answer, please. Do it physically, do it on your own, and then make sure you know it.
I was able to get that.
Okay.
Yes, me too.
Okay. So basically, try all these questions on your own. And then if you've got any questions, basically, I will be repeating myself now. So I will just move on. And unless and until you've got some questions, some more questions for me. Also, if you, I don't know if you received I sent you an email. I've opened an extra credit practice exam for you. So I've given you 2 attempts on it. So do it. That'll give you a good practice.
Thank you.
And there are 12 extra credit points on this. Okay. And your exam 2, you have to log in through Zoom. It will open on 4/8/21, 10 to 15 minutes before the exam time. So you'll have 15 minutes before it and 5 or 10 minutes after that. Okay. Okay. We will move on now to the responsibility accounting and performance measurement. Now, what is the idea behind this chapter? As the word suggests, it's basically performance measurement and responsibility accounting. So obviously we will measure performance. And then the question is, how do you measure performance? You will have some ratios to measure performance, some formulas, or maybe there is one or two techniques like balanced scorecard to evaluate the performance. And then we will also talk about responsibility accounting. What does that mean? Basically, whenever a group of people are responsible for something, like they might be responsible for managing cost, managing profit, managing investment in the business, those are called responsibility centers. And how do you account for it will be what will be the focus of the topic. Also, when you are operating an independent unit or independent profit center, then how do you show the performance of that unit? What is the difference? How do you modify the contribution margin income statement to show the profitability of the business? Now, the first thing that you need to understand or concept wise you need to understand is the difference between a controllable cost and an uncontrollable cost. And as the word suggests, a cost is controllable if the manager has the power to determine or at least significantly affect the amount incurred. Is that within the manager's control or not, basically? And second is uncontrollable cost. So obviously, opposite of that, if it is not within the control of the manager or manager cannot influence the cost, then it is uncontrollable. So when you evaluate the performance of a manager, should you take into account the uncontrollable cost or not?
No,
No, why not?
because it's not in their control.
Obviously. So as the word suggests, it's not within their control. Now, some cost can be controllable at one level and are uncontrollable maybe at another level. So as a professor at IUP, do I have any control over the, uh, say, the uh, salary for the dean? No, right? Or salary for the president for that matter. I don't have that control, right? But president might have president and the provost might have a significant control over the dean's salary. Or the board of governors may have some significant control over president's salary. Or the governor might have control over that. So the same cost can be controllable and uncontrollable depending upon the level of the organization the person is operating at. So what does the responsibility accounting system do? It basically helps to evaluate the managers on controllable items. So for example, a department manager may receive a detailed report about the department expenses. A store manager might receive a summarized information from each department. So there are different levels. So now if you look over here, In this case, Executive Vice President, US Operations. Those costs for the salaries of they're showing that as part of their controllable cost. Now for the West region, they got a summary amount. So all these costs are probably controllable at the level of Executive Vice President for the US operations. Now for the Vice President of the West region, maybe their department, which is a beverage department, has all these costs. All these costs are controllable at that level. So it's just depending upon the hierarchy. You already know the definition of direct and indirect expenses. Direct expenses, you can directly relate to a particular segment of business, of a product, or a process. Indirect expenses, you use the allocation base, which you have used in the past to allocate those expenses. And generally, we have used allocated expenses based upon the percentage of allocation base that has been used. So as long as you can have a cause and effect relationship like we saw in activity-based costing or some other method, whatever is reasonable method of allocation, you can do that. So here are some examples of a service department. Now, what are service departments? Manufacturing departments are clear, right? You've got whichever department manufactures it, so it's a manufacturing department. Service department, on the other hand, are more or less those departments which exist to serve the other departments. So for example, HR department, it basically serves all other department. Or cafeteria department, it serves meals to all other employees. Accounting department, it serves all other departments. So those are service departments, and you can have a base to allocate them their expenses also. So in this case, for example, office expenses based upon number of employees or sales in each department, personal expenses based upon employees, and so on. Maintenance based upon the square feet of floor space occupied, because that's the cleaning part. Again, this is a cost allocation for janitorial service of $800 per month. The square footage occupied is 60%, 15%, and 2,400 square feet, 600 square feet, and 1,000 square feet, or 60%, 15%, and 25%. So 800, 60% of that, and so on. We have allocated the cost based upon an basis of allocation. And again, this should not be new to you. We have done this many times now. So what we are going to do is we'll have the, first of all, accumulate all the revenues and direct expenses by the department and total indirect expenses as well. So when you are making a departmental income statement, you'll do this. Then you will allocate indirect expenses across both services and operating departments. And then you will allocate the service department cost to the operating departments. So you'll allocate their own costs, direct costs, then the indirect costs using whatever basis is needed, and then the service department cost. And that will help you to prepare the departmental income statement. So we have got A1 Hardware. Their service departments are general office and purchasing. These are the expenses incurred in the general office, and these are the expenses incurred in the purchasing department. These are the three operating departments or manufacturing or production departments. These are the two support departments. So these are the costs which can be directly allocated to the operating departments. So that's given to you. Now coming to the indirect expenses. So indirect expenses, we have taken the rent and allocated it to all the other 5 departments. Similarly, we have got utilities expense based upon the floor space, then the sales, then the advertising expenses based upon sales, which will be for operating departments, and insurance expense based upon the value of the assets insured. So those are the bases that have been used to allocate the expenses for the common expenses or indirect expenses. Then next is your general office expenses. If you, after allocating part of these expenses from the indirect expenses, your total general department expenses is 15,300, and this now will be allocated to the other service departments, and same thing here, we have allocated it to the remaining operating department, sorry, all the expenses based upon sales or purchase orders. So now we know that the income for each of the operating departments is as follows. Oh, I didn't see there were messages here, sorry. Oh, that was for Kate. Okay, that was long time ago regarding Kate's music. So Kate became popular for a minute. Yeah.
Best I've done in my whole life.
So my son does that too. My elder son, he kind of makes music and plays, and he has his own studio, wants to start something on, what do you call, a podcast also. Anyway.
That's cool.
Anyway, any questions on these allocations? Means you understand what allocation means. You understand how you can use any basis to allocate. So here are the departmental income statement. It's very similar basis. We just came up with it. Okay. And then you can imagine that whenever you allocate these share of general office expenses and other expenses, whenever you allocate these expenses which are not controllable by each department, then the problem becomes that people will start to question these bases as to if they are using those services, should they be allocated, should they not be allocated, etc. So it's kind of a very difficult decision to be made, but you need to allocate it so that you know that no one is misusing the facilities, no one is misusing the services. And it has to come out of somewhere, because out of the operating department, because the entire service department exists to serve the operating departments. So departmental revenue minus departmental expenses will give you the departmental contribution margin, which will be used to evaluate the departmental performance. And when the departmental contribution becomes negative, it becomes a candidate for elimination. So if you look at it, you've got the sales minus departmental contribution is after your direct expenses, all your direct expenses, you've got the departmental contribution. Now, should we close appliances? Probably no, because it will still give 9,500 towards the meeting these indirect expenses. Is everyone okay with this format, please? Any questions on this format? Now, as far as an investment center is concerned, investment center managers are evaluated using the performance that combines the income and the assets, both. So this is at the highest level. Investment centers are at the highest level, and they decide where do you invest the money, how much money do you need to make, etc., etc. Now, the most popular measures for evaluating the performance of an investment center are return on investment, residual income, profit margin, and investment turnover. So this is at a highest level that you're doing. What does return on investment means? Basically, how much money are you making based upon the average invested assets? How much money are you making? What's the return on your invested capital? So this is what the investment center average invested assets are and investment center income. So in this case, LCD is making 21%, S-Phone is making 23%. This is one of the most popular method and most commonly used method. It takes into account the income from the income statement and invested assets from the balance sheet. What does average invested asset means? It basically means the same thing. Average is beginning of the asset balance plus ending asset balance divided by 2. Any questions, clarifications here, please? What is residual income? Residual income is investment center net income, which you already know, minus the target net income, target investment center net income. So what we are saying is assume that the target net income on the invested asset is 8%. Think about it in a way, suppose before I go over this, think of an example. Maybe you bought a house, and when you bought a house, you're probably also paying some loan and so on it. So when you bought a house there, you got 2 options. One, you can live in it. Second, you can rent it out, right? Or third, you can resell it, I guess. But I'm assuming there is those 2 options whether you can live in it or you can rent it out. If you live in the house, that means you cannot rent it out. If you cannot rent it out, that means you're losing the income on that investment. So there's an opportunity cost associated with it. And that is what we are talking about over here. That when we put that money into the company, we cannot use this money for anything else. So 8% of on 2,500,000 is 200,000, and the cost on 1,850,000 is 148,000. So this is kind of an opportunity cost, or the cost or the money that you cannot use. So our true income is not 526, but 326, 500, and 269, 600. Theoretically speaking, residual income is a better measure than the ROI, because in the ROI, your in return is based upon your investment. And suppose this was not 2,500,000, but 25 million investment, then your return would go down. So it depends upon the investment. Or on 25 million, you could have made much more money than you can make on 2.5 million. So in this case, the size does impact the returns. In this case, your investment center residual income, the size does not impact the returns. Or at least that the opportunity cost of that investment is taken out, kind of. Okay. Any questions on residual income or ROI? Next is we are using the investment center analyzing investment center using profit margin. As the word suggests, it's profit margin and investment turnover. As I said, accountants are very creative people. So return on investment is made up of two items, the profit margin and investment turnover. The only thing is the extra item is the sales. So investment center income divided by investment sales. So how much did you make on the sales? So for example, Apple makes about 28, 20, 30% on their sales, net income on their sales. Tesla, on the other hand, make 1 or 2%. Walmart probably makes 4% to 5% on their sales. That's the investment center income or the profit margin. Investment turnover is investment center sales divided by investment center average assets. How many times are you turning over your assets based upon your sales? So is your asset turnover 3 times, 4 times, 5 times, 6 times? Means sales, investment turnover at McDonald's will be much higher than investment turnover at Boeing. So it also depends upon the industry in which you operate. So again, in this case also, just write down the formula. As long as you understand it, you fill in the numbers. That's it. So profit margin, your income over sales, 6902 over 23,510, and profit margin for parks and resorts, 20.49. Investment turnover, 0.72 and 0.64. This is a number of times. And if you multiply the two, that will give you your ROI. Okay. Questions, clarifications, please. Let's do a couple of problems. I'm on chapter 22 homework, problem number 122-4. I'm assuming that, can I assume that you can do the allocation? You have done it so many times. Means if you have to do it in this case, advertising cost 106,000, your department sales are given to you, and you department sales are given to you, and you have to allocate the advertising cost based upon the department sale. So 250 over total 1 million gives you 25%, 500 over 1 million gives you 50%, and so on. So that's the allocation base. 25% of 106, 50% of 106, and so on. You know that, right? Okay. The same thing. Again, in this case, it's based upon the square footage occupied allocation. Okay, computing the residual income. What's the formula? Net income minus the cost. So your targeted return is 15% of average invested asset. So your target income is 15% for all three. Average assets are given to you, 25, 17, and 12 million. 15% of this gives you the target income. Net income is given to you. Net income minus that targeted income of 15%, which is computed here, gives you the residual income. Any clarifications, please? I'll come to this cash conversion cycle and efficiency a little later. Let me finish the ROI part today. This is again an allocation problem. Okay. Investment center analysis. They're trying to decide two alternatives to open. First location requires an investment of 500,000. So average invested asset is 500,000. The second, and it yields an income of 80,000. So 80,000 is your income. So 80,000 by 500,000 gives you an ROI of 16%. Then the second one has an alternative investment of 200,000. That is for an income of 42,000. So 42,000 divided by 200,000 gives you 21% ROI. So you have to compute the ROI. Which location should the company open? The company chain generally generates a 21% return on the total assets. So this more or less limits the choice to, right? So location B, so although this has a higher number here, but does not meet the company's ROI policy or targeted income policy. Sometimes the question will become what do you do if it is at 20% instead of 16%? Should I take it? Did you not take it? How hard and fast that 21% is? Okay. You have to compute the ROI and residual income. Same way, you know how to compute the ROI, net income by average invested assets. That's what I was saying last time. Means if it is too close, then what do you do? Like 16% and 15%. Kind of. So depending upon what the companies need, in this case, assume a targeted income level of 10% on the average invested asset. So we should be fine with either one, I guess. So you need to compute the residual income. In the residual income, you got the target net income that is given to you, then your 10% on the invested assets gives you the residual income. I hope I'm not boring you with this thing now. It's becoming too simple, I guess. Okay, any questions, anyone? Okay, so that's basically part of the ROI method and so on. Now, as far as the departmental contribution report is concerned, again, very similar to what we have done earlier. You have got these operating expenses. So we need to show a departmental contribution report that shows contribution towards the overhead. So manufacturer is considering eliminating its electric guitar, this one, because it's showing a loss of 3170. The company classifies advertising, rent, utilities, expenses as indirect. So advertising is indirect, rent and utilities. So rent, utilities, and advertising are indirect. Those three are indirect. So those three will basically be towards the after the departmental contribution margin. So we took all these expenses and found the departmental contribution margin, and the indirect expenses, we took them out later to be allocated. So when you take that out, actually both of them generates a positive contribution margin, departmental contribution. So if you take this out, electric department, if you take it out, it will increase your loss by 9770. Why? Because it is still contributing 9770 towards these common expenses. Okay, questions, please.
No.
Okay. So based on the contribution to the overhead, should it be eliminated? Answer is no, because if you eliminate it, as I showed you earlier, you will lose, your loss will increase by 9770, because these expenses are not going to change. Rent is not going to change. Utilities, advertising, these expenses are not going to change most likely. Kate, are you going to do MBA?
I'm not sure. Probably not right now, but I'd like to eventually.
Okay. Yes, I was wondering if you want to go for early admission or not on the MBA. Okay.
When does that start, the early admission?
You can do it anytime. You can try to take 1 or 2 courses in the fall, means because some of your courses can double count. So if you take the admission, you can double count some of the courses towards the bachelor's also. And that is a message for everyone, means.
Yeah, I'll definitely look into it.
Yeah. Talk with me if you feel like.
Okay, will do. Thank you.
Anyone else who is interested, let me know. Okay. I think this will be a good point for me today to stop. Instead of starting the second new topic, I have about 7 or 8 minutes left. I can do 1 or 2 more problems, or I can stop now. I can probably do one with the uh, service department cost allocation. So here is a service department, advertising department expenses 71,000, and purchasing department is 78,900, to be allocated to operating departments on the basis of dollar sales. So advertising is based upon dollar sales, and purchasing based upon the purchase order. So those are your 2 bases to allocate the cost. Again, it boils down to, so this is the ratio: 201 by 420, 92, 400 by 420, 126 by 420. 1225 divided by 2500, 725 by 2500, 550 by 2500. That's basically the basis. And then you can allocate those 2 costs. So first is the based upon the sales. You found the basis, you know the basis is 48% to books, 22% to magazines, 30% to newspaper out of the 71,000. And that's how your 71,000 is allocated. In the case of purchasing, the base is number of orders which is given to you. So the ratio becomes 1225 by 2500, 725 by 2500, 550 by 2500, which will come to 49, 29, and 22%. You use that for allocating the 78,900 to the 3 departments. So you have your own expenses. Then you took the 71,000, allocated it into 3, and you took the 78,900 and allocated it to the other 3. All the expenses are now allocated to the 3 manufacturing departments or operating departments. First of all, any question on allocation of expenses? Any question on this column of allocated cost, please, from anyone? Once you have this, we know that you allocated this to the other 3 departments. That's what this is showing. So the cost after the allocation, they had 213,000 of its own cost, and this is the allocated cost. So the total cost allocated to books is 285, 196, and 306 for newspapers. And anytime you've got instructions like this in red, do not ignore it. because the system will not recognize your answers or mark it wrong if you do not use a minus sign for subtracting, especially like this. Because if you don't put a minus sign, this will add it up and it'll keep on showing as wrong. Same thing here. Is everyone good with that, please?
Yes.
Okay. Now we talk about the joint cost allocation. What do I mean by joint cost? Joint costs, the costs that are incurred for the joint product, means joint item. Now, what does joint cost really means? Think about, just to give you an example, when you got, suppose, a dairy that buys milk from farmers, whatever milk they buy is like a joint cost, because the dairy uses that milk to produce, say, cheese, skim milk, or yogurt, and so on and so forth. So there are many products that are produced from that common product. So that's basically the joint cost is the milk part. So that's, just keep that in mind. We'll see how maybe they are using it in some other context over here. But that's what generally joint cost basically means. It's a common cost, kind of. A company purchased 9,200 square foot commercial building and spends additional 86,000 to divide the space into 2 separate units. Unit A has 1,200 square feet, and Unit B has 8,000 square feet and can be rented for 90 cents per square foot. How much of the joint cost should be assigned to Unit B using the value basis of allocation? So in this case, your market value is at 1,800 for Unit A. And Unit B at 7,200, 8,000 times 90 cents. So your numerator is 1,800, total denominator is 9,000. So basis becomes 1,800 to 9,000 and 7,200 to 9,000. So 20% and 80%. Your cost that needs to be allocated is 501, 20% allocated to Unit A, and to Unit B, remaining 80%. Again, just allocation of the cost, nothing much. Now, do you understand why on the first day of the class, I gave you all that example to make sure you understand the allocation of the cost clearly? Because you have used that now in probably 5 or 6 chapters. Okay, guys, any questions here, please? I will wrap up this chapter on Thursday, and I will see you on Thursday. Any last minute questions?
Yes, I have something about the tests
Yes, sir.
that's on the 8th.
Yes.
I have an FTX for RTC on that day. Is there any way I can take the test earlier?
Not earlier, but I can give it to you later.
Okay, thank you.
You can just send me a message and I'll work accordingly.
Okay, thank you.
When do you plan to take it?
It was due on the 8th, so I can do it after the FTX. And I come back that Sunday, so it should be Monday. I'll be back.
Okay, whenever you're back, just let me know.
Okay, thank you.
But just to let you know, you might have you will most likely have a makeup test, which will be different than what the class is taking.
That's fine.
Okay. Any other questions on this, please? Anything else you would like to share, discuss? Otherwise, I'll see you on Thursday at, Thursday is 29th. Okay,
Thank you. Have a good day.
you too, take
Have a good
care.
day.
Bye, everyone.